Kokkie Kooyman, it's so good to be seeing you. Cape Town in winter is not a bad place to be. Usually, you're a traveller. I suppose in the last through the COVID, the last couple of years, you surely haven't been doing as much travelling as usual.
Yeah, funny enough, I miss it. I don't miss sitting at the airport lounges and in the taxis and so, but you're just being face to face with management. And I did do a quick trip a few months ago, and one of the analysts is in Europe now seeing all the banks, and everywhere you get the same reaction. It is so good to do a face to face meeting again. Guys are really enjoying it. So, yeah.
Nothing quite like kicking the tires, but here in South Africa, we're a bit removed. And so, not surprisingly, you shared an email with me from saying that some financial advisors are a little concerned about what's going on with banking shares. Before I go any further, just for those who've never met you before, Kokkie Kooyman is our South African go-to guru on financial services stocks, been doing it for 4 decades. He
50,
is a
40, almost 40.
almost for
not
4
quite,
decades.
Not quite as long as David.
Well, we do know Mr. Shapiro is a world champion when it comes to longevity. But Kokkie is a director of Denker Capital, and as always, it's good to be able to talk with you. I was actually chatting with Sean Pesh yesterday, and asked him a question on banks. He said, "No, you better ask Kokkie that one." A former colleague of yours, sometimes.
Yep, we work together at Old Mutual and regarding Wiley.
He's just as excited as you are about banks, incidentally. But why are financial advisors nervous?
Alec, it's and I'm sure a lot of your listeners, this will resonate with them. It's simply the price falls. So funny enough, when prices go up 30%, nobody worries. Or in the case of, as profitless tech was doing, it went up 100% to 150%. They weren't worried when they should be worried. And now bank stocks are actually down quite a bit, 30% year to date globally. South African bank shares have held up fairly well, although they're also down, I think, 20% for the quarter. And then suddenly people read the headlines, recession coming, Fed is going to hike interest rates aggressively. That means bad debts. And, then they start getting worried and they say, and the problem is both on the upside when you have this excessive optimism, and on the downside, we get this pessimism. Investors forget to look at the valuations. So now if you look at the valuations, and I know Sean liked ABN AMRO, that is, I think it's now trading at 0.4 times price to book. It's a 60% discount to tangible net asset value, and it's a dividend yield of 6%. Now,
just
we think they are actually even...
Kokkie, just explain what is price to book, and when you say 60% discount to tangible net asset value.
So Alec, because earnings, specifically in bank stocks and insurance stocks, are very volatile, and we'll come back to that just now when we look at, let's say, Goldman Sachs' results, we tend to look at the book value of the banks and insurers, and we look at cheap or expensive relative price to that book value. So let's say JP Morgan is trading at $100. Well, ABN AMRO, let's say ABN AMRO is trading at €40. That would mean at the moment it's book value. In other words, what the business is worth per the audited financial statements. If you add all the assets together and you subtract the liabilities, then you get €100. So you're basically buying €100 worth for €40 at the moment. Now, okay, as you know, in any asset, you can buy a cheap house at the moment, but if you can't rent it out, then it doesn't help you buy a cheap house. So you want sea facing. Yeah, same with banks and insurers. So what we then look at is the return on capital that you get on that book value. So ABN AMRO, that's why it is cheap. Its return on capital has been about 6%, which, by the way, in Europe, that is not bad. And in Europe at the moment, because of the low growth, they tend to pay almost all of that out in dividends. So that's why so for what you buy, you get a dividend every year of 6%, and that should grow. And at some stage, when Europe starts growing, now Europe is a slightly different story, and all the guys are cutting costs and doing a lot of things, that return on capital will go up. And as that goes up, then you should get closer to book value. JP Morgan now, for instance, in that same example, is trading at $100, and its book value is about, and its price is about $100. So it's trading at 1 times, but its return on capital is 11%. So you can see 11% versus ABN AMRO's is 4%. So the higher the return on capital, the higher your price to book value goes. And it's like earnings. The higher the earnings go, the more investors will pay in terms of PE. So maybe one more, US Bank, or a share bank we hold as well, it's a more commercial bank, gives you a return on capital of 20%. So that trades at 2 times book. So in bank investing, what you try to do is you try and find those banks or insurers that are mispriced. So if JP Morgan post a recession, return on capital goes back to 15, just with all those numbers I've quoted, clever listeners would have worked out JP Morgan should then trade at 1.5. Mm-hmm. And that's where it actually did. I think 12 months ago, JP Morgan traded at 1.6 times book. It's now at 1 times book. And that's why we know JP Morgan is a great bank for one, very solid. And so when all this uncertainty changes and as interest margins open up, they will get the return on capital up and you'll get a re-rating. So you benefit both from the 10% or 12, whatever that is, per annum growth, and you get a re-rating.
Kokkie, you've been doing this, as you say, for nearly 40 years. What have you learned in that time that you can apply to this stage in the cycle right now?
Yeah. The main thing, Alec, and you've been at it as long as I've been, we've seen a lot of bear markets and we've seen a lot of panic. And I've learned every time when you get to the stage when people are worried and they just want to, I myself sometimes just think, why am I sitting with these bank shares, and they just keep going down. And that's where our advantage is. We go and see the management, or now it's been Zoom calls, but we go and see them. I saw Legal and General the other day. By the way, that's a global or British-based insurance business. It's very diversified. It gives you a 7% dividend yield in pounds. And I saw them, and I asked them, so I walk in and say, okay, why is your share price so down? And they say, every meeting we have, it's the first question we try and address. What is wrong with the message that we're giving to the market that they don't understand, the value we're creating? Their return on capital is 18%. And they believe next 2 years it will actually be higher. So here are the people working with the business, seeing the numbers, and they can't understand the share prices going down. So the lesson you learn is, look at the valuations, and if it's a good quality business, but the returns on there, and they've got a long track record, that's when you just, the most difficult thing to do then is buy, because it could still go lower. But the worst thing you do then is sell. So in the 2008 crisis, I actually had a period for a week. I couldn't sleep. I had to go to the doctor. He had to give me a tablet so I could sleep at night, one that just knocked me out, because you were so worried, is this going to be a 1930s depression? But every time you learn, and the good banks just come through it. They provide upfront, they diversified in their loan books, and the same now. So the best thing now is, and that goes for most stocks that have come down quite a lot. Now you must just sit through, be patient. The market will turn as sure as day follows night, and the economy will turn as well. And generally, it's never as bad as it was anticipated.
We've seen in the last few days the beginning of the US's quarterly earnings season. Every 3 months of the year, they bring out their financial results, and there's lots to learn for people like you, who then communicate it with people like us in the detail of the results. We've had a number of the big American banks reporting already. What's the big theme for you so far? And I say this because Citigroup, for instance, their numbers came out, share price up 13%. JP Morgan's numbers came out, share price down 3.5%. Goldman Sachs's profits halved, and the share price went up 2.5%. So it's very confusing for people outside of on the outside looking in.
Yeah. So it's to do with, I would say, 3 factors on the questions you asked. Number one, obviously the valuation. So Citi, on our price to book as 0.6, but it does almost the same return on capital as JP Morgan. So that shows that investors are concerned about what they're doing. I think investors are wrong because the management under the new CEO have been doing a lot of things, disposing of non-core assets. But bottom line is, when the results came through, it was better than expected. So the share price goes up 14%. JP Morgan, actually results were slightly disappointing both on revenue and on profit because Jamie Dimon decided to take a very big provision. And we'll come back to that just now. But his outlook statement was very bleak. And look, he's been around a long time, longer than us, actually, almost. I actually met him once many, many years ago when he was still CEO of Bank One.
He's a bit of a rock star, isn't he? I don't know if you saw, we crashed the series that was on Apple about WeWork, but Jamie Dimon had a starring role in that miniseries.
Yeah, and by the way, he's also very outspoken. So people like, but when a guy like that comes and says, firstly, he was warning there's a hurricane coming, and then he starts talking about, look, we're taking big reserves. But the words he used was, there's a lot of uncertainty. And he says, even a war creates more uncertainty. So people look at his results and then look at the big provision. And instead of just taking his word, they think, wow, this guy is taking big provisions. What might he know about bad debts that are coming? But his result was a bit underwhelming, and I think almost he's putting aside too much, but he's in it for the next 5 years. He bought massive stock, a number of shares in JP Morgan last year. So he's looking at it for the long term.
He did personally. You say?
Personally, yes. He bought 500 million.
But that's a good thing, isn't it? If your CEO is buying $500 million, where does he make that amount of money?
Yes, yeah. Most we sold it earlier when it was higher. They're well paid. They are very well paid. Look, I wouldn't want his stress. But if you then look at Goldman Sachs, then again, market's slightly worried because it is a true investment bank. So investment bank earnings are very volatile. You could see it as well. Their top line was down a lot there because market activity discontinues. Big corporations stand back, first wait before investing, before doing merger and acquisitions. So the Goldman Sachs result, despite, as we used to say, optically looking poor, was actually much better than expected. And so on the short term, the market reacts positive.
Mm-hmm.
But I think what is... Yeah.
And then the European banks that are coming through as well. Is there anything that you can pick up from what you've seen on Wall Street in the last few days that can be extrapolated to when the European banks report?
Yeah. So what is important, the banks we've mentioned now, JP Morgan, Goldman Sachs, and even Citi, have a large component investment banking in them. So there's a lot of trading activity, a lot of client trading. And so when you carry that across, you can see it was actually quite volatile, but generally profitably. So if you look at the European banks like Barclays, BNP, SocGen, Deutsche Bank, which have a large investment component, based on Americans, it should be good, although market activity is down. But if you look at the main message, I think, from the banks that we saw was loan growth was still good. Average US loan growth, 6 months on 6 months, up 10 to 12%. That's actually quite good. And all of them saying our clients show no signs of stress. The most important thing, because of higher interest rates, the net interest margin has been increasing. So you saw Bank of America as well, interest income up 20%. Oh, that is big. Operation expenditures well controlled. So if it wasn't for the provisions, they would all be showing very good results. And we're expecting the same from Europe, not as good in terms of loan growth. Europe is just slower growing, and there's the worries about the war. But there as well, they're only starting the interest rate hiking cycle. Well, in fact, 21st. So that is was Thursday, Friday. So Christine Lagarde hopefully will hike by 50, 25 basis points. But so gradually they'll also see higher net interest income. Still good growth and bad debts, like in Europe, still very low. I think Bank of America is a good example there, and what investors must watch out for and what they must remember. So last year, this time, for the first 6 months of the year, Bank of America, okay, maybe we go back one more year,
Mm-hmm.
2020, COVID. The banks made huge provisions for COVID, potential bad debts resulting from the shutdown of the economy. 21, those bad debts didn't come through, so they released them. So in the first half of 21, Bank of America released 6.5 billion of reserves back into their income statement. The profit for that year was about 20. So you can see how big that reserve release is. This year, so far, the first 6 months, they've made a provision again for potential losses next year of 3 billion. That's a swing from a 6 billion release into the income statement to a 3 billion taking out, 9 billion on a profit of 20. So that's why the profits look as if they're down 30%, but the underlying businesses are actually doing very well. And so
Got it.
back to your question, Europe, we expect the same. The underlying business doing well. The loan growth is still there. The net interest margins are increasing, and they are putting profit aside for potential bad debts next year. And that is what's driving the share prices down.
So bringing it back home to South Africa.
Yeah.
The last time we spoke, I got so excited about what you said about ABSA that we added it to the Biznews portfolio, and it's done okay. It's actually gone.
Isn't okay.
It's
Yeah.
ahead of where we bought in.
Yeah.
Is that still the kind of stock to hold? And I'd like to kind of unpack this in something that Piet Viljoen was saying, because he has ABSA, Sanlam, and First Rand in his portfolio, in his top 10, those three. And he says that First Rand and Sanlam are well-managed, great entrepreneurial culture, and something that the market doesn't believe will continue, but he believes will continue. So put that one side. And then ABSA, on the other hand, he says has been badly managed, but is now being well managed for a change. Your thoughts on those points?
Yeah. So a bit of spot on there. First Rand is just such a fantastic, well-managed business. And it still comes back from the founding ethos of Lowry and GT and later Paul Harris, those three guys, the whole, and then Johan Berger. And there's such a culture that was generated and in the guys there, and the way they do things and the way they think, and then it starts working for you. So First Rand return on capital of about 20%, and there's a high degree of certainty that they will deliver that for the next few years. So if you think back just to how do you think about investment, you want three things. You want a good valuation, you want good growth, but you want a high degree of certainty. And First Rand, through their track record management, gives you that certainty. Now, Capitec, First Rand trades at 2.5 times book. Capitec now trades at, relative to its past, cheaply 5 times book. So, but for Capitec, you need an even bigger degree of certainty, which the market has, that because it's trading at double the valuation as First Rand. For almost the same return on capital. So the market is saying they're going to grow that profit stream at that rate for much longer. ABSA is trading at 1 times book. And ABSA, the current team, I think have done a lot of work, and they started that 4 or 5 years ago when they did the big turnaround, did a lot of introspection, looked at where they lost market share and set in practice new operating ways, new marketing strategies, and that's coming through. So the return on capital of ABSA is coming through. So I agree. It's also one of our biggest holdings, also First Rand, and then Investec, and then ABSA. Investec is also a team really done well in turning a business around that was, especially in the UK, floundering. ABSA,
perhaps I'm being simplistic on this, but if I'm buying Capitec today, they would find it much more difficult to go from 5 times book to 10 times book than ABSA would from 1 times book to 2 times book. Is that?
Absolutely. So ABSA could, in a very good scenario, if let's say our government comes with us. Unfortunately, a lot of things in South Africa do depend on the government. They come with a big plan and say we're going to do this and this, and our GDP growth goes from 2 to 4%, and then ABSA just on that macro scenario uplift could go quite easily from 1 times book to 1.5, 1.6, and then as the environment improves, loan growth comes through. Then the return on capital could quite easily go to 20. So that's why most investors in South Africa have started adding ABSA, trusting that management will do well. So there's a big responsibility there on the board. Selo, who's taken over as chairman now, to make sure that as a board they keep that management team focused and incentivized to deliver the results.
I want to talk to Sanlam to end up off with, but before we go there, you've opened a door, which is something that we've been exploring at Biznews. Post 2024, a new government, a new coalition government, with a different economic policy to the ruinous one that we've seen for much of the past 28 years. How would that be interpreted, and how, if that were to eventuate, would that impact particularly banking shares?
Yeah. Alec, it reminds me of the conversation I had with Stephen Kosseff, I think 2 years ago. And you know what Stephen is like? He used to shout, "I phone Cyril 7 times a day." And then he only replies once or twice, telling him what he should do. So, and, Stephen would use a lot of expletives in those. But the low-hanging fruit in South Africa, if the government was to engage with the private sector, is just so massive. Just think of the capital needed to recapitalize and put Transnet, to put SABC, to put SAA, to put Eskom back on track, power generation, our harbors. So this country can quite easily grow at 5, 6, 7% for a few years if we were to have a Nelson Mandela who engages with the private sector and gets them to commit, and foreigners will come streaming in. So that is your golden scenario. So yes, the ANC government just hasn't listened. It's ideological problem. So a new government, 2024, and it's shaping up that the leaders of those parties that we're listening to now that are coming through understand that. And so if they were to come to the private sector, a lot like Nelson Mandela did, and say, let's work together, then quite easily, you should be buying South Africa and bank shares now. Because your bank shares, remember, because the banks are the oil that lubricate the economy. And so the faster your economy grows, the more it needs banks to provide the capital to do the arrangement, to do the transactions.
It does surprise me that corporate South Africa in general and investors in particular haven't yet clicked to the reality of what everything is showing us about what's going to happen in the 2024 national election. But we're putting that aside. Let's close off with Sanlam. That was the other stock that Pitt had. I'd love to get your insight into it. I know you're part of that group, so I suppose you've got to be a little more careful to be too bullish.
Yeah. Well, I've got the advantage of Denker is 49% held by Sanlam, so I'm standing half on the outside. But I've known, the past 5 CEOs fairly well. Paul and Ratio actually worked with at Old Mutual when he was still there. So Sanlam has actually done well, because of capital allocation, the way they allocated capital over the years to Africa and to India, where they're getting very good returns. Hani Worth is really the star, a person very few people know about, who's really done and drove that strategy. But internally in South Africa as well, it's a phenomenally managed business. So the price is down a lot because, like all the other insurers, they needed big reserve payouts for COVID, for business interruption, death claims. But so there are 2 things important here going forward. Number one is the opposition has been weak. Liberty has been weak. Momentum was in turnaround mode. Old Mutual is plagued by boardroom troubles. So it was easy for Sanlam. If those other players come right and they start, competing again, that will be a bit of a headwind. And then you've got a new CEO in Paul Enright, a slightly different style, less consultative, more directive. And so if he can keep his top team together, I think that's going to be critical and keep them motivated. Then, there's a return on capital of 20%, a bit like a Capitec, a First Rand, that just powers away a few there. And we need Africa and India to do well as well. India is going through quite a tough period at the moment with food inflation, but, it's a country that will grow at a high rate for many, many years. So India will do well. Africa, they're also quite diversified. They've just done the tie-up with Allianz. And so, first, Sanlam is our fourth largest holding. So there you go.
Kokkie Kooyman, Director at Denker Capital, and I'm Alec Hogg from Biznews.com.